The minutes of the Federal Reserve's first meeting of 2015 were released on Wednesday. This as investors look for any clues on when the central bank will raise short-term interest rates, which have remained near zero for over 6 years. For more reaction, I'm joined by Bob Johnson, Director of Economic Analysis at Morningstar, with us now from Chicago. And Bob, the Fed seems to be in no hurry to raise rates. Is that the sense you got from the minutes?
I think in some ways I agree with that. In some ways I disagree. I mean, the phraseology seems to use words like several when they talk about people that want to raise rates, and use the word many when they talk about people that seeming to want to keep rates where they are for now, because the risk that raising rates might have on the economy. But that's pretty slim evidence to go by it. There's obviously a crowd that thinks they should raise it sooner than later, and there's a crowd that thinks we should keep it low for a while. So there's still no real agreement. What I found interesting in the minutes is that there were substantial parts of the document where how, when we do raise rates, do we communicate that with the street and with the press, and how they might react and what words we might change. If they've gone into that much detail of thinking about it, it tells me that they're thinking about a rate increase sooner than later.
All right, so what do you think? When should the Fed raise rates?
Yeah. So much of the minutes today were premised on, the labor market's really picked up, GDP was great. I think the economic data over the next few months may turn up to be a little bit weaker, and it may be a little bit weather related, but I really think we had those two great almost 5% quarters, and then we had 2.6% in the fourth quarter, which I actually think is going to be revised down to 2% or less. And then you're going to get into January and February. They're going to be addled by the weather. So I think the economic data is going to come in a little weaker. They've got a little time if they want it. Right. That said, I mean, right now, inflation's running kind of 1%-ish, and the interest rates, short-term rates, are clearly running below that. It's an abnormal situation. We need to get rates in the short run at least kind of back up to what inflation is. And as far as I'm concerned, the sooner the better.
Right, and of course we got some more poor economic housing data this morning. Now, if they don't tighten this year, I mean, how long can the Fed play this game? At some point, the economy needs to stand on its own 2 feet, right?
Yeah, exactly. I think that the low rates aren't helping all that much. I mean, I think they could move up the rate some, and it really wouldn't make a big difference. I mean, people are not buying a home because rates are 3.5 instead of 3.25 or whatever. That's not enough to really swing the needle. I think that actually by them saying maybe we're raising rates, maybe people would actually be more excited about saying, oh, I better quick beat this before they raise rates some more. So it could be almost paradoxical when they begin to raise rates. It actually helps housing out a little bit.
All right, and finally, the Fed also said low crude prices could be a headwind for economic growth, that if money stops flowing into the energy industry, that could hurt the economy overall. Your take?
Absolutely will. I think that everybody's kind of forgotten. Everybody's been a real cheerleader about lower gasoline prices and how much more money consumers have to spend. But by the way, those gas prices are up from $2 to $2.50 or so in some areas, and so it's interesting that some of that party may have already ended. And now we're starting to see the layoffs in oil industry companies. We're seeing orders for goods that are used by the oil industry. We've seen the actual industrial production of very oil-related products start to decline. So we're going to see an increase perhaps in consumer spending. Well, even that hasn't come through in spades yet. At the same time, we're going to see business investment related to the energy patch anyway come back down a little bit before anything else can accelerate to kind of take its place. So energy is not a one-way street here. It's going to help parts of the economy and hurt other parts.
All right, Bob, we'll leave it there. Bob Johnson, Director of Economic Analysis at Morningstar, thanks so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.